Hello and welcome to a brand new show of Market Makers. My guest on the show today is Traun Kataria, Chief Executive Officer of Religare Capital Markets. Mr. Kataria, what a delight to have you on ET Now. Thank you for joining us. Mr. Kataria, Greece is a disaster. France and Germany are not talking to each other. US economic growth has been anemic and China is threatening to slow down. Are we living in dangerous times? Are we staring at more difficult period in coming months and coming weeks?
Well, disaster is probably a bit of a strong word, but I think there is general cautiousness globally. I would look at it slightly differently. Europe is very much priced into the market. If anything, there's risk of some upside coming through that, because if there's some settlement, if the Greece situation, if the election works in everybody's favor, I think that very negative price action that we've seen over the last 2-3 months sort of fades away. So there is some risk that actually this thing looks a little bit better. The US, I think, while we're having a little bit of a sluggish period, I think is on a sustainable path to growth with 0% interest rates. Liquidity always wins, so I think the path is right on that. The concern to me is really China, because I think most of the planet is sort of saying China is able to bring itself into a soft landing mode. If that doesn't happen, and China does hard land, then of course the dynamic globally changes and looks quite different. My own view is China has sufficient fiscal and monetary power still to ensure that it doesn't hard land. So if it doesn't hard land, commodities look different, global economics look different, global macro looks different. But yes, overriding there's sort of a pall generally with the state of the planet.
So at these rates, are markets pricing in a disorderly exit of Greece?
I think markets were pricing it in until about a week ago, but I think now that they're seeing the poll results and then sort of Greece actually saying, listen, no matter how hard it is, we really need to stay in this. Because if you step back and think about what it means to actually exit the euro, you've got all your assets that are in drachmas and your liabilities are in euro. The currency has to fall, right, to realign itself. And what are you left with? Expensive liabilities, cheap assets. Very hard to arbitrage that. So I think as painful as it's going to be, the euro does survive. I mean, we all agree structurally it's seriously flawed, and there needs to be a convergence of real fiscal and monetary and political union almost. But in the meantime, I think Greece stays in there and suffers the burden of being part of the euro.
But can growth and austerity coexist? That's the hottest debate. One side of Atlantic, it's money printing, which is US Fed. Other side of Atlantic, which is Britain. They're trying to do all the right things, but growth is not coming there.
I think, listen, it's about balance, and nobody suggested anybody's got that balance right. But I think over the long term, the types of things the UK is doing will pay off. In the near term, there will be pain. The euro structurally is different. For them to actually do that, it's very hard to do, because in a situation like this, you need to let the currency go. How do you let the currency go? Because that's what is required in Greece, but not required in Germany. So that balance becomes even harder in Europe to sustain. And so there will be generally a convergence on the downside. It's no different than when East and West Germany merged, right? There was sort of a convergence to the lower end of the scale, which needs to happen in Europe, and that's going to happen over the next decade. So as much as Germany might want to fight it, it has to give a little bit.
Do you think the center of gravity after 17th of June could shift from Greece to Spain and from Spain to Italy? Then Portugal also could be the joker?
Well, I think that would be too scary to even comprehend. And I think if that happens, then the euro story is over. Then you sort of bust up and you go back to what you were before. But personally, I don't think they let it happen. There's too much riding on it. If you let one go, where do you stop at the second and the third? Which is why I also think that Greece remains. And I think as structurally unsound as the euro is, I think it probably stays.
Are you a bit surprised with the strength in dollar? At a time when US economic growth is anemic, just about everybody is hiding in US denominated assets, US treasuries, which don't give you a yield of what, more than 1.7%?
It's flight to safety, right? I mean, every time you have some sort of crisis, it's flight to safety, it's flight to US dollars, it's flight to treasury, and we've seen that over the last 2-3 years. Structurally, over the last 10 or 15 years, there was a thought that there would be flight to euro at some point, because the euro was trying to also become a reserve currency, but that market is not big and deep enough to provide that sort of And of course now, given structural issues, that's out of the question. But whenever there is, uncertainty around the world, you fly to dollars. And somebody once asked me, if there's uncertainty, do you fly to the emerging markets? The answer is no. Because the emerging markets remain at risk, the currencies remain at risk, so you will always return back to the US dollar, which is what we're seeing.
Is it time to buy fear?
Depending on where you are, it's really about portfolio, right? Now, if you look at bonds in whether it's Europe or US, massively overbought, right? At some point, this thing sells off. Flip side of it is actually a great time to be buying equities, because to my mind, the time of maximum bearishness is the time to be buying these products. But you've got to have stomach in the meantime to deal with what might be another 5 or 10% correction, and volatility. So volatility is here to stay. If we can deal with that, I think it's a great time to be going long equities pretty much everywhere.
Are you a bit surprised with the way how foreign institutional investors so far for this calendar year they've invested, which is about $8 billion, a record number, but we still have a sub 5,000 print on the Nifty? I
think all of this, or most of it, in fact all 9 billion, I think happened pre the budget, right? We saw 8 and then we saw $1 billion, I think it was, that came into HDFC. Since then really nothing has happened. The question is what's changed, and I think January, February was about allocation, new allocation into India, new allocation to the emerging markets, so we saw some of that. I think there was a strong sense at the time that interest rates would come off maybe as much as 300 basis points. Post the budget, I think that changed. People were confused about the budget. They were confused about some of the assumptions that were being made in the budget about deficits, about GDP growth for the fiscal, and that strong sense that rates would be cut by 150, 200 basis points came out. Markets have been stagnant. Really nothing's happened since. FI flows on balance have been flat to negative, and certainly domestically not much going on as well. So that's really the FI story. Generally, FI is also very jaded about India at the moment. There's been a lot of sort of back and forth, flip-flop, no real policy direction. The question some might ask is, why isn't this at 4,600 or why is it not at 13,000? The answer is they're probably sitting tight. They're not taking their money out in large amounts. There's probably a realization that that funnel effect will actually create the negative spiral downwards in terms of valuation. So I think they're happy to sit on what they think is negatively priced in. There's probably upside from here. Let's hold tight. Let's not completely exit. If there was an exit to the door, it looks quite different.
Is that your view as well, that incrementally it's difficult to find what could go wrong from here? On the flip side, incrementally it's very easy to find out what could improve from here.
I think you're right. I mean, so much negative has been priced in. You could have a political realignment over the next few weeks. I think that if it happens the way I'm thinking in my own mind, I think that would be a huge catalyst on the upside. You've got at least 2 or 3 catalysts that can move this market. The risk of a massive exodus of FIs, I think, is low, and that's the catalyst that could take it down dramatically, but I think that risk is low. So the risk on the upside, I think, is actually quite interesting.
So essentially the short-term trigger has to be something monetary. It cannot be fiscal.
I don't know where the fiscal room is at the moment and where the ability to execute or deliver the fiscal change. Obviously it should happen, but with sort of disparate views and disparate parties and the raucous democracy we all live in, to get some of that over the line is tough. I mean, we've been talking about GST for the longest time. Now, GST, to my mind, is probably the one reform that creates immediate impetus, immediate value, immediate GDP growth. That would be great. Now, FDI and retail, etc., on the margin, great to have, sends the right signals. But in terms of immediate impact, a GST type thing should come through very quickly. That would be terrific.
If someone walks up to you and his question is, look, I'm ready to digest a 10-15% volatility, but give me some ideas, give me some sectors, give me some names which have potential to become 2x, 3x in the next 5 years. How would you address this query?
That's the smartest question anybody's asked me in a long time, because everybody's saying, what should I do today for tomorrow? To me, India is exactly that story, and this is the advice that we've been giving the long-onlys and many of the hedgies who are sort of saying, what should I do in India? I'm all confused. Volatility is great, but it's too much volatility for me. I said, there are a whole series of really high-quality stocks that it's boring to buy and hold but that's something to think about. In the near term, you need to be defensive. So, we think with the currency doing what it's doing, IT's, mid-cap IT in particular has some good value. Pharma is a place to hide. Consumer stocks, while expensive, still, over a 5-6 year period, will still continue to do well. If you're looking for that 3x return, that high beta story, I think banks look very, very interesting. So that's something that we've been talking to our clients about. Anything for the moment that's sort of capex cycle related, industrials, we're sort of backing off against. But, there are 15 or 20 names that you can buy and hold for the next 5 years and do very well by.
Do you think banks will lead the rally whenever markets will bottom out now, whether it's 4,500 or whether it is 5,000 on the Nifty?
I think banks will lead the rally if you have this view again that rates will be cut as we saw in January and February, but banks were up 20-25%. So if that view starts to form, then absolutely, because they've been beaten down based on sort of NPL perceptions. I think that's, to our mind, the high beta name. And you should be, certainly in the private sector and the PSU banks as well.
What is driving consumer stocks? Now, consumer stocks, like you said, they normally tend to outperform when market conditions are challenging. But is the defensive trade now getting extremely crowded? Just about everyone is trying to hide under the desk. Suddenly I find that people under the desk, they are getting crowded.
Yes, but I think the consumer story is intact. And if you look at the branded story, I think that continues. I mean, they're all trading at 30 times, but, earnings are still doing quite well. Input prices are probably coming down a little bit. So I think that remains a place that people will continue to gravitate to. And especially, as you said rightly, if you've got a 5-7 year view, great place to be.
But in the near term, if I look at the basic macro setup, salary levels have been static, inflation is high, and high interest rates is now eating into your savings. Does it make sense to ride the consumer momentum? Because consumer spending ultimately is a function of discretionary spending, which is now getting challenged.
I think that's the risk in the next 6 to 12 months, because to me that is the risk in that whole consumer story, that it actually pulls back a little bit. So I think you're absolutely right. But I think it's a sector you have to be in. It's a sector that will continue to grow. Now, should it be priced at these levels at 35? That's a different question to ask. But I think as a sector, I think it remains quite strong. On a 3-year basis, do you think US equities will do well or Indian equities will do well? I would like to think on a 3-year basis India does well, because quite frankly the S&P has done really well over the last 18 or 20 months, and so will get more and more expensive over time. If you believe India at 12 times relative to its mean of 14 or 15 times is really undervalued, I would like to think India certainly offers a lot of upside over the next 2-3 years. Yeah. If I look at the history of bear markets have bottomed out when P multiples for the Sensex, they've plunged below 10. They're still at about 12 times. So if I look at the history, the downside risk is still open. Well, history doesn't necessarily mean whatever that expression is, which I forget. But I think India, which continues to remain a 6%, maybe you'll have a 5.5 annual GDP print, but basically 6 to 7% GDP growth economy. I would like to think that we're not going to see 9.5, 10 times. But 11 is fairly valued. We need to be at 13 or 14, and really that's the upside from here. Would you say what also could bail us out is expectations, because there are bears everywhere. No one is ready to buy equities. There is no retail. And HNI investors, either they're parking the money in gold or they're buying real estate. Yeah, as I say, if there are a couple of catalysts, this thing, you could see some pretty aggressive move up. There's no question in my mind about it. But you need that catalyst, which to a lot of people is really not visible at the moment. And rightly so. I don't think it is really that visible, whether it's interest rates, whether it's some sort of political realignment, as I said. If that happens, and if earnings and commodity prices continue to come down, there's some sort of talk about, let's sort of this whole fiscal deficit that we need to make sure we temper. There's a rollback of the subsidies. If people see some of that, I think this looks very different. Will markets be seriously disappointed if we don't hear anything on diesel in the next 10-15 days? I think the market was disappointed a couple of days ago when the minister said what he said. Yes, the answer is yes, right? Because it creates a whole hole in our fisc, and we'd like to see some of that not be rolled back, or indeed maybe even diesel rolled in. The market will be disappointed, but we've had that for the last 6 or 8 months, where things have been said or executed and been rolled back. So it wouldn't come as a surprise, but it's not the right outcome. Will you be surprised if rupee goes below 60? You mean above 60? Yeah. I would not. I have said, for quite a while, 60 should be something that we should all be thinking about. We're at 56 and change today, so I think to get to 60, which is 7 or 8%, is actually not that hard. And I think we've got a structural problem. It's not that it's about flows. It's structurally people are saying, is India the right place at the moment? And with the sell-off in bonds, in some of the FIIs buying bonds, I think you could see 60 here.
Do you think for Indian equities to bottom out, rupee has to bottom out first?
That's a good question. I think there is some truth to that. If there's a sense that the rupee has sort of found its level at 58, 59, so that sort of one negative catalyst, if you will, goes away, yes, I think that does help, yeah.